Welcome back, everybody. We have a lot to go over. S&P rallies, pulls back. Why do we pull back up here? Well, there's a bunch of reasons for it we're going to dive into. I think the most important thing to just state is we've come a long way in a very short period of time. If you look at this 100-day low, which is right here, and then you look at these 6 days that rallied, when we did this, we did something we haven't done for 20 years, and we talked about that and the significance of it. And now we're at a point where in this period of time, if you take a look at that, you're up 10%. This is from peak to trough. This is a huge move in a very short period of time. It's good that we digest it. I'd like to digest it, and I'd like to get the opportunity to actually buy dips. As we've been talking here for about a week now, we've been dip buyers ever since the Fed meeting. I'm not overly surprised by this. CPI was out. CPI was pretty significant. We're going to go take a look at the effects CPI has had on the market. We also need to take a look at the amount of money that's going to come into the market. Pretty specific, and I think we should address it. But now, this technically speaking, we have this doji sitting here. Let's just drill into this a little bit and look at what's actually going on. We're somewhat looking as if we're going to roll, right? Here's my issue with this and why I'm not thinking that we're going to come in too much. Now, you never know what tomorrow brings. Every day is like a box of chocolates. But here's the break on Tuesday where we just exploded on CPI. Here's today, and we just kind of go through this. I can't even get to the middle of this bar. I can't even test the middle of that bar. I can't even get to the 50%. We can't even test the bottom on the hourly here. And look at where we're at already. Now, this is the same exact thing that we just went through. We were just talking about this move and how we were overbought and we came all the way down to oversold, and look at the difference in the movement. And I think that there's a really important distinction here. So if we're looking at the peak of overbought, which was here, and we move all the way over to where we are oversold, we were actually up by the time they worked it off. That's pretty staggering. So let's drop this and take a look at this on a 4-hour and see if we're noticing anything. Well, here we are on a 4-hour, on the 4-hour RSI. So we take the peak of that, and we're going to go all the way over to where net. We have a 1% drop on a 4-hour chart. That's absolutely staggering, and that shows you the strength that we're dealing with here. So for me, the level that's most important, and probably a level that a lot of people are just really overlooking and not paying attention to, I tend to take these bars, and yes, you could use fib levels, but I'm going to see the 50% line, and I'll tell you why I use 50% sometimes. Specifically, I want to see how buyers and sellers flip. So this is the news bar. This is CPI bar. Has that flipped? Has it come even close to flipping? And we just worked off this entire overbought and we're heading back to neutral, or we're going to be oversold by tomorrow, depending on what tomorrow's news brings or what happens tomorrow. So if we take a look at this, I think it's a pretty darn good day that we're up 18 basis points. Now we should talk about the data and we'll get into that, but we have a lot to cover. And if we just look at the most simplest things again, we're heading towards overbought. You don't sell when you're getting overbought. You sell when you pop overbought and then you roll back down. So we don't know how long this is going to begin. I'm not really that nervous that we didn't make new highs. I think that you kind of have to take it as a grain of salt, and it is what it is. I mean, you're not going to go up every day. Just to put it into perspective, if you take the peak here, and you go to the top, you're 2% away from hitting year high. So I wouldn't mind some backfill before we push again. Matter of fact, I would welcome it. So at least 44.50, even this 44.30 level, I would welcome. Now, if you take a look at the NQ, we got right to the high. And like everything else, first time, usually you knock on the door, they don't answer, you have to knock again. And that's where you have this little doji sitting up here. We really don't need to spend a lot of time on this. I'm not adding a tremendous amount of value by saying we're above every single moving average. I mean, you should be able to pick that up by just looking at it. Does the doji bother me? It doesn't light the world on fire for me. I'm not excited that there's a doji there. That doesn't change the fact that this is one enormous cup and handle that we've been talking about. And we just draw it out again, but you guys should remember this. We've gone on it ad nauseum. And I do appreciate all the comments on showing live trades. I'm going to show another one today, and we'll walk through it. I do think they're great learning lessons, and I think it's a good way to show things. And you can see the handle right here as well. I know people tell me that there's a way for me to go here and hit control and do this other stuff. Candidly, all I have to do is go clone and drop it down, and I get to draw it exactly how I want it. So I think I like that better. I mean, if you have a better way, I'm all ears. Someone told me about the clone button over there. That's a little nightmare, quite frankly. But if I can get through here, all right, so I'm breaking out of a multi-year cup and handle on the Nasdaq. That's not something that I'm going to short. So people can look at this all they want. There is a massive amount of money that's probably going to come into this market from the way that I see the world, and we'll get into it. And yeah, the game has changed, and adapt or die. And as I always say, you have to look at the macro. you have to look at the fundamentals, and you have to look at the technicals. Now, we will review the big trades and the bigger names, and I do want to go through a bunch of slides to show you where my head is, but I do think we should just talk about Target for a second. So take a look at this earnings report. It's been a long time since you've seen something like this from Target. Target is usually the one that everybody is talking about and everyone's saying, oh, it's going to be a disaster. Quite frankly, I thought it was going to be a disaster as well. It wound up being a great trade. And what we did was we had our level, our demarcation level drawn. And then from that level, we were able to determine where to get in the trade and execute. And it worked out very well. Able to pull money out on the way up. And I'm just going to walk you through that trade right now.
We're going to want to watch Target and watch how that acts. I would think, there I go again, thinking that it should do okay, but we don't want to watch that anchored VWAP off the open and go from there. Then see how that responds. Target here too. And okay, so you held that level. So that would tell me that Target's probably going to go. Let's get involved. What Target here? I'm going to watch this level right here and see how it does and go from there. So far, what have I done? I bought Disney and I bought Target. Wow. I'm at 126.80 on Target. So you're just day trading it. When it does these little spikes, you just pull money out. Let me just drop these up here so I can actually watch them at Target. All I've done is buy Disney and Target. Wow, what a day. Someone told me this was going to be my day. So, and then if you're just day trading these, all you're doing is pulling money as they go up. That's really all you're doing. Okay. So FYI. All right, here we go. Trying to get through 94, pulled a little out, 50 cents. Right. So just pulling money out, protecting myself. That's all I'm doing right here, guys. That way, if I can stay in a portion of these, I'll be happy and just let them work. If they're going to spend the day, grinding higher. Right here at Target, 1, 2, 3, flips the open, holds our level. Boom. We bought up $1 and watching the world go by with it. Up $1 there. Target up $2. Hold something out right on that little pop there. Well, let's see. Right now, I'm all about Target. Now this is doing exceptionally well for me. So I'm not really doing much more. I'm watching the Target trade. And then when it pulls up, I'm just pulling little bits of money out when it does these little spikes like that. All I'm doing is just pulling a little out right into it. So I really don't want to be in Target. I have very little interest in actually holding this, but it's doing very well now. So I'll stay with it. There we go. Trimmed more Target, put the rest of the stop at 126.88 right under that open. I'll just leave it there. There we go. Up 3, pulled more out. All right, so we're making money there. Target, we're absolutely killing it. So Target trade was right off that level. We knew the level from here, so we knew what we were watching, right? So we had our level all marked off. We saw it hit our level and bounce, and we saw it on a microscopic level and how it acted. So that allowed us and gave us an opportunity. And we knew this extended area through there. And then we watched this anchored VWAP and we watched it get over that anchored VWAP and close. And that gave us everything we need. So that's got us 3.5 points. Something as simplistic as that VWAP and knowing where your support and resistance are. I don't even need to look at volume. You're clearly going to have a lot of volume. It came out with earnings. The volume is going to be above average, right? What you're trying to do is you're trying to do removal, right? You're trying to do like removal process when you're doing it. You want the least amount of variables that you have to look at. You want them when you need them. When you don't need them, like I know the RSI is going to be overbought. You already know that. Looks like Target's just going to grind higher. I'm waiting for something to tell me I'm wrong. $4 in Target right now. I did trim it on the way up and I'm just waiting for something to kick the rest. I really don't want to hold this. It's giving you this doji right here. Perhaps a close under that doji might be something of interest. This VWAP closing below that might be, I feel like I'm struggling today. You could get below this 128.50 maybe. I don't think I'm going to go for that kind of, but I'd like to see what this target, the remaining target position is this. I'd like to make a higher high and then I'd be able to use that low as the stop. That's what I would like. And what I'm going to get are usually two different. I have noticed. So what this is doing now, if you have these two down, you see how the reds are like doji. So if I was to go here and measure these bars, then I'll take questions. But if I was to go there and measure these bars right here, right, you'd see that you're still 50%, right, is right there. So you broke below that, which would make you somewhat concerned about that bar, right? You measure that bar and you're not at 50%. A matter of fact, 50% gets you to what? Low right there, which is also the low of that. So this made my life very easy because if I break this right now, after this bar form, I break that is now my stop on the entire trade. It just made my life super easy. So if I break that now, we're pushing 5 in Target. I'm not doing anything, guys. I'm just going to watch them now. Let them do their thing and just keep moving the stops up. And I'll let you know when I'm out of them. I'm 100% out of that target. I'm not saying that's the end of it, but I'm done. It was a day trade. Target can go higher, guys, but it's a trade.
So I appreciate your comments on these, and I appreciate you stating that you want to see more of them. I think it's a great way for you to go back and watch those videos. When I have time, I actually think I should clip a bunch of those out and start putting them together so people can just run through all the live trades and go from there. I'm also thinking about just putting a file out. I literally have hundreds and hundreds of hours of me live trading. I might just all put them in a Dropbox and you guys can just go look at them. They're all unedited and everything, so you can just see what's going on there. Thinking about doing that. Comment on that if you think it's a good idea. I think there's a lot in there. I think I'm better off pulling them out, but I'm always interested in your comments, and I appreciate your sharing these. You'd be surprised the amount of people that contact me when they're shared. And I also appreciate the fact that I don't have to edit things like that out. So let's get to it. So, all right, so this is where we are with Target. And so they're saying the consumer's good. Now we're going to go into Walmart. If Target's good, Walmart's usually good, and we're going to have to watch that. There's a bunch of names and sectors that we really should talk about, but before we do, I think we need to take a look at the macro picture. So one thing that I think is being lost on everybody is just how different the landscape has changed in a week. And I truly don't think that people are getting it. So I just want to start here and say on November 7th, and you can see right here, and this is from CME Tool, and this is the target rate probabilities for what they're going to do in December. So 1 week in December, on November 7th, when we were here on November 7th, you can see 9.8%. That is the probability that they're going to raise rates. But in October, there was a 29% chance in October that they were going to raise rates. So I want to be real clear about this. You're a month out now, 29%. Then we went to 9. Then between the 7th and the 13th, we had data that scared people, and we went to 14. During this scared period of time, do you know what people did? They panicked. When they panicked, what do? They put money in money market accounts. That's going to become pretty pivotal to what we're going to go over. 0.2% is where you're at right now. There is a 0.2% chance that they are going to raise rates right now. That's where you're at. You're not raising rates. And the other thing that's happening is Fed swaps. So Fed swaps I'll cover maybe on July, June. I'll cover those, the June, July Fed swaps this weekend. If you're interested, comment below if you want me to cover them. But essentially, the rate cut got moved from July to June. And by the time that we're done, after today's data, we're going to be looking at March, which is what Goldman's been saying, quite frankly, but we'll see how that plays out. But this is a really important distinction. In 30 days, this is what's transpired. The game's changed. You need to change with the game. Now, we're spending time so you can understand when I say the game's changed, what do I really mean by that? What does that mean? Well, this is weekly flows. Weekly. So it's been 1 week flows into global bond fund. And it breaks it down so you can see 927. They do their numbers weird. They'll say we do them weird, but we know that they do them. Right, so here you are, November 8th, okay? So you can see November 8th, November 1st, October 25th, you get it. All right, so it's a Reuters graphic, but this is what I want to point out. If you look at how this is all playing out, bond emerging markets, look how low that's getting as far as withdrawals. Right? Negative is withdrawals. Look how low these are getting on the withdrawal side. Now look what they're doing. They're buying Japanese bonds. Well, why are you buying Japanese bonds all of a sudden, considering that they were blowing them out? So that's interesting. Right? I think it's interesting. Look at government bonds. You went from negative to positive on government bonds. That's also very interesting. If you take a look at it, it was one of the best weeks we've ever had. But then there's this thing that's just absolutely glaring. Two of them, a matter of fact. Loan participation funds are seeing influence. Funds that are guaranteeing loans or supplying loans, rather, right here. You're at highs. High yield bonds. Now, let me be really clear about this. If you're worried about default, do you know where you're not putting money? Into high yield bonds, into loans, into corporation. You're not doing that. You're not going to be at the end of the food chain. Okay, you're going to be putting money into corporate bonds, investment grade bonds. Look what you're not rushing into. So they think that this comes in. In other words, they think that the default rate comes in, or they wouldn't be participating in this kind of thing. And I think it's a really important distinction that this is a massive, massive change and a massive inflow into these two sectors that are considered the most riskiest in the global debt market. Now you're going to say, well, why does that matter? It matters because if they thought there was an issue, they wouldn't do that. Now, this is just a headline, and I thought this was fascinating. But money market fund assets climbed to 5.58 trillion, 14.3 poured into money market funds. Government fund assets rise by 8 to 4.6 trillion. So that gives you an idea of the scope that's in money market accounts. Just the sheer scope of it. Okay, so now we understand the scope of it. Let's take a look at a couple things. This is where you were during a global pandemic, meaning protect my money. We don't know what's going on in the world. We're all locked in. We're all sheltered in our houses right here. Protect the assets. Look where we are right now. We are protecting more now on an asset basis than we are here. And we're going to say, well, what about that 1.7 trillion that the Fed put in? Well, the majority of people actually lost that money. If you take a look at this, you're actually up higher than you were here. Now, what happens when this money starts declining and coming out of money market accounts? Well, why is that going to happen? Well, if the Fed doesn't raise rates and people buy bonds, then we know for a fact that yields are going to drop. If yields drop, money market accounts cannot pay more than they're going to get on those bonds. They can't do it. So people are going to take money out of money market accounts, and what are they going to do? They're going to buy assets. Okay? They're going to buy risk assets. So they're going to go with the risk-free rate, which we went over on Saturday. I'll link that video at the end. So they buy the risk-free rate. What does that do for us? All right, so they're going to buy the 10-year. Everybody remember this? So if the 10-year yield drops and the dollar drops, equity goes higher. You have more dry powder here than any time that you had in a decade. We all see this, right? You see that coming straight across. Okay. Then now you have this. What happens when they start deploying this capital? And let's be really clear about this. This deployment of capital is when the market ran. That's when we ran. And then we had our little blips. And then look what happened in Jan 22. And then look what happened right after that Jan 22, when they start like hibernating and hiding their money like squirrels. Same thing happening, substantially higher. So we're looking for something like this to start happening as this goes on. And that money is going to start deploying into risk assets. It will not stay in money market accounts because they're going to get less risk or less return. And the thing about it is, people that are in these funds, like if you have money at Goldman or BlackRock, wherever you have your money, you know this. You're fully aware that the 2-year is plummeting right now, and you know that they're not going to be able to pay it. So you know that you have to make decisions, and staying stagnant is not the decision that you're going to make if you are a modicum of what's about to happen. So key takeaways here, I thought this was really interesting. Money market funds attracted 184 billion in net inflows, almost 10 times higher than the net inflows by category of intermediate core bond funds. The Federal Reserve's fight against inflation, corresponding interest rate hikes have pushed up rates for low-risk money market account investment products. Rising interest rate provide more competition for stocks as equity funds. ETFs suffered net outflows in the quarter. This was November 8th. And this was the headline of that article. Money markets saw outsized inflows amid stock bond jitters, November 8th. Do you have those jitters anymore? So now we have a bunch of people that sold bonds, sold equities, panicked, and threw their money into money market accounts. This is fund flows. EM stands for emerging markets, equities and bonds. Equities are green, gold are bonds. This is a Reuters graphic. Look what's happening for the first time. For the very first time, you have net inflows into emerging market bonds in this quarter. That's not a coincidence. Now, does today's data support what happened and what my theory is suggesting? Here's PPI month over month. And we all know that corporations are not going to cut their prices so that we can benefit, right? They're only going to cut their prices or leave their prices the same if they can make the same amount of money. So here we are month over month. I'm looking at the previous and the consensus. So if we look here, we're at negative. This was the previous, this was the consensus. Retail sales are down 0.9, negative 0.1. We were looking for 0.3. So they actually came in better than expected. And then this was the previous. Core PPI 0.2, 0. Okay. This is showing deflation, by the way, when you have a negative. Empire State Manufacturing, you can see we're supposed to be where we were, what we were expecting, and manufacturing's better. Year over year, 2.4 versus 2.7, we were supposed to come in at 2.7 lower. You just go through them. Every single one was lower than expected. Every single one. You were looking for 1.9, you came in at 1.3 on total PPI. Retail sales year over year, last was 4.1, 2.5. There is nothing about this that says inflation. Zero. So when we see the bond market sell off and people say, oh, well, we're going back up. The bond market has sold down, yield, I should say, should be more specific because I like looking at the yield, has sold down 11% in this period of time. You've never seen a move like this fast off of yield. And I think that's a really important distinction, all right? Again, we've only seen a move this strong off a 100-day low one other time, and it was 20 years ago in the equity market. So this is what we have now. That is where money is flowing. The game has changed, and you can either accept that the game has changed or you can stick with the same thesis. But the game has changed. That doesn't mean that every day is going to be rosy and the market's going to go up every single day. You still have margin rates, you still have players, and you don't have a Fed backstop anymore, right? There are certain things that you are not going to have that 2020 had. So that's why the market's not going to act the same. You can see the rally right up here, the sell at the end of the day. Obviously, people aren't going to like that, but if you start taking a look at certain sectors, you are seeing them start to develop. Let's get rid of this. It's from the newsletter. If you are on the wait list, make sure you take a look in your inbox tonight. There's letters that are going out for those that are on the wait list to join the community. And I think it's open for a couple more days, and then the community will shut down for the rest of the year so we can focus. I open and close it on purpose, and I purposely offer to talk to every single person that joins the community. It is an actual community. So if you can see what's actually happening here and how we're pushing, I don't see how we're at least not going to test the top end of this channel. I just don't see it. DPST is the name that we've been talking about on this channel for some time. I don't know if today's the day. You've had a huge move. Candidly, you might want to give it a little bit of time, see if it can settle down, you can get a better price. I don't know if we're going to get that or not. I think Walmart's going to set the stage for tomorrow, but I still like the way the regionals are acting. I'm kind of surprised this NYCB is acting the way that it is. This is one that I'm very interested in, and I'm just going to explain this. And I want to show you something else I'm really interested in too. But you see this NYCB? This was one of two banks back here that was allowed to buy assets. Remember when we thought we were going to lose every single bank in the world and we were all going to be walking around without a bank? Well, what's fascinating about this is that's the day that they were allowed to buy those assets. So that's when they're allowed to go out and actually purchase. And it was a home run for them. I mean, it was an absolutely home run. You're at the same exact price. Now, this is where it gets interesting. Here's your test. Here's your retest. I could put in my moving averages. We already know they're going like this. We already know the volume's going to be awful because nobody wants a regional bank because they don't understand the turn in the market that happened. When you understand macro, it starts putting the pieces together. So just so we're clear, this is where every bank was blowing up and we were never going to have another bank again, right? And then we started trading up and saying, well, maybe they're all not going to go to zero. This is when they announced that they were allowed to buy assets, okay? Once they were allowed to buy assets, this is what happened to those assets, all right? So you had a 1,500% jump in earnings, 332% jump in revenue. All right, how'd they do next quarter? Up 90% from there and a 36% jump in revenue. So just to be really clear, 1.2 billion in revenue. Before they were allowed to buy assets, they were doing around. So now after these 2 quarters of earning at the same exact price, it doesn't make any sense to me. So names like this, if you can spend the time and dig into them, names like this, they don't make any sense anymore to me. It doesn't mean that they're going to go right up, but it's like SLG still trading almost at 50 cents of book value. It makes 0 sense to me. But I think you might be dealing with some tax ramifications, and that's what I'm thinking. But then I have this marked off here. It's not exact. I'm actually going to clean that off and mark it exact. And what's important about this? What's important about this is, so am I going to get the tax selling? Is that the problem? That I'm going to get tax sellers? Well, when I got to the anchored VWAP price of the year, look what I did. I held. So I think that's really substantial. And I think that that's something that we need to pay attention to. If you look at the leading names, they're doing okay. They're not doing exceptional. And that's just rotation. So you're seeing like Arete break out. I mean, this is substantial, guys. Breakout by itself. This is called a Marbuzu White. Forms an island reversal, breaks out again. Are you going to have some kind of pullback? Yeah, you have to expect some kind of pullback. The goal for us tomorrow is going to be to watch Walmart and see what Walmart does. If you look at Walmart right now, you never know. It could be a sell the news event, right? We just never know what you're going to get. But if you look at Walmart on a weekly chart, we're at all-time high, and there's nothing there. There's nothing above you. So I think that's really important. Target did exceptionally well today. So the retail names are actually doing very well. We did see Amazon hit like a brick wall today, and you can see right in there, you just hit it like a brick wall. Now, are we tired? We could be. I mean, that's a big move. 110, right, all the way up. I mean, you can see, well, 120, I'm sorry, all the way up. So it's a big move in a very short period of time, and I think you can do some digestion. I don't think that's the worst thing in the world. SOXL, all you did was come down right to the previous gap fill, form a doji, and sit here right in here. I don't think that these are the worst moves. I mean, that's really the point that I'm getting at. These reversal bars, they're no different than what we had a week ago. And what happened then? And then they're reversing, and now we're hitting highs. I mean, you're at 52-week highs. So the fact that these are down on the day, I think you should need to take it with a grain of salt. You mean we didn't take out a new high on AMD? So like, we just have to put things in perspective a little bit, and just instead of expecting that, oh, we're automatically going to roll again. You know, until the bond market gets to the point where it's going to sell down, I really don't see the sense in panicking here. It doesn't make a lot of sense to me. Now, take a look at this. There are 2 graphs that I like to use. This is the first one. So stocks above the 5-day moving average. Whenever we get up into the 90, you're setting yourself up for some kind of pullback. This is S5FD. Anybody can use this. Anybody can spend time with this and understand it. But when you get into the 90s, you're usually setting up for some kind of short-term pullback. Why is that? Once you're over 90, there's nothing left to go up on the short term. That's one important data point. Here's the more significant one. Every great sustainable move in the S&P this year happens when we get over 50%. And every great sustainable break happens when we get under 50%. So if you look here and you say September 14th, 15th, and you come, here, let me clean this off. And you come here and you look at the SPY and go, well, here's September 14th, 15th. And then we broke down. Okay. Ever since then. These are pretty significant, and especially on a long term. So when you break above it, like you did here on Wednesday, June 7th, and you can see right here, you had a nice move. So I would watch both of those. You can watch those through TradingView. Other services have them as well. And overall, I think the market looks just fine. And I would just pay attention to one more thing. We're all watching XLK, and we're all seeing it break out here. We're all seeing this breakout, right? This enormous breakout of new highs on XLK. I would not sleep on the XLC name. They still have a ways to go, but they're still breaking out, and they're still at 52-week highs. That's it.